Welcome, everybody. We will do the proverbial Zoom welcome while everyone sort of slowly trickles into the Zoom room. It is as if it is a real room and everyone is funneling in from the back. Come to the front. There's lots of seats up here. We'll give it just a couple seconds for Zoom to catch up with everyone. Awesome. Folks are just flying in. Bob,
This is
you are
this is an
popular.
angry looking audience. They're ready for trouble, I think.
You know, I tell the team that every time I give my presentation around like the future of financial planning or working with younger clients, there's always like this one older gentleman sitting in the middle of the audience, arms crossed, just shaking his head at me the whole time. And I love it. I'm like, good. I like disagreement. I want this discussion, but awesome. Well, welcome everyone. Thank you for joining today's Solution Spotlight with my esteemed guest, Bob Veras. So, Bob and I hosted part one. I think it was this time last year, wasn't it?
I don't
I
remember
don't
when
know.
it.
Sometime. I was talking to someone recently, and I was like, "Yeah, that happened in 2021," and they pulled it up, and it was like 2018. I'm like, "Okay, I'm losing my sense of time completely." Um, but yeah, so Bob, as you all know, and he can give a brief intro on his background just so that you know a little bit about where he's coming from. But Bob is a industry commentator and expert on the industry, and spends a lot of time thinking and talking about where the industry's going. What does the future look like? Sort of what's around the corner. So really excited. Bob has some initial questions that he's going to go through, kind of pose, and we'll discuss. But if you have specific questions that you would like for Bob and I to answer, just throw them in the Q&A. As we have time, we will pull those. So if you have any additional questions, feel free. Bob, before we kick off, do you mind giving just like a 60-second background on yourself, just so that for anyone who does not know you yet, they can orient themselves?
It won't take a whole minute. I'm the publisher of something called Inside Information, which comes out monthly and talks about all the different topics that I think financial planners and advisors should know about. Every issue is different, obviously, but the key trends, the key issues, the most interesting things that happen. And I've been doing this for more than 40 years. So at some point, wisdom is supposed to seep in. I keep waiting for that to happen. I'm sure any day now it's gonna strike me.
If you just speak very definitively, then it sounds like wisdom. That's the trick. So
Oh, all right. Oh.
if you are an XYPN member, the inside information that comes out each month, that is in the member forum. So that is available. That's a member benefit that we have. Grateful to Bob for letting us make that available to all of our members. And I should have said, hi, I'm Alan Moore if we haven't met. Nice to meet you. Welcome, everyone. I am one of the co-founders and the CEO here at XYPN. So I have been here since day one when we were dreaming this idea of how do we help advisors start and run and grow their own RIA, their own independent RIA. And 11 years later, we have over 2,000 members now and still growing. So it's been a really exciting time. It also has put me at sort of the forefront of where I think the industry is headed, because we have so many new firms that are starting every year that they get the opportunity it's kind of like turning a sailboat instead of a battleship. They're really nimble, they're really quick. And so it's really cool to see sort of what everyone's testing and trying and where they're trying to go. Compared to some of the larger firms, which it just takes a lot more to turn the bigger firms. So with that, Bob, I'll turn it over to you, and you can sort of introduce our first question.
Well, my concept of this session, this meeting, this discussion, is that I'm going to blindside Alan with debate topics that I think are really interesting, and I'm going to take a position, and then I'm going to see if he could defend the opposite position, which I'm sure he'll. I told somebody online, they said, this sounds like a cage match, and my response was, I will crush him. So we'll start. Why not? So the first debate topic, I think there's a lot of talk out there that scale is a definitive competitive advantage. Without significant scale in their operations, smaller firms let's say $1 or $2 billion in AUM, simply will not be able to compete with the emerging acquiring giants. The big firms, they can leverage a single back office across multiple locations and many advisors. They're more efficient in that sense, or should be. They can offer a broader array of services because they have more people. Their staff can specialize more tightly on certain roles, and not without having to wear multiple hats, they can be more effective in their activities. And they're going to have a larger marketing budget because even if their percentage spend on marketing is similar to what smaller firms are spending. So the first debate topic, I'm going to take the position smaller firms are doomed.
Mm. So yeah, why do you think that is? Just all the things you've just listed, or is there more to it of like why you feel like small firms are not going to be able to make it in the long run? Like what tells you that?
Well,
What
there's so many,
evidence?
well, there's so many competitive advantages. I mean, this is mostly theoretical because there hasn't been enough consolidation yet. But there are so many competitive advantages that I think a lot of, particularly firms, in the $100 million range, say, there's no way I can compete. I have to sell to them in order to get the scale I need in order to compete effectively for clients and to continue my business life. And so, and they're right. They just have to sell. There's no other way around it.
Yeah, I mean, it reminds me, or I guess the best metaphor that I have for this is, when if I'm thinking about starting a craft brewery, I'm really into beer. I want to start a craft brewery local here in Bozeman, Montana, and serve my community. Do I ever think about Budweiser or Bud Light or any of their mass produced things? Because like Budweiser, I think they're owned by InBev now and maybe by somebody else. Like they have operational efficiency and they've been able to scale and they have a marketing budget that is more revenue than I will make in a lifetime per quarter, probably. And yet I can still build a super successful business. And so, in I guess a better metaphor to our world is CPA land. There are four gigantic firms that have consolidated, that have built these massive operations. And there's a very, very long tail of CPAs. I think the average CPA works in a firm with two total CPAs. And so there's been this proliferation of independence. And so I don't think that the large firms will do anything to harm the small firms. I think what it has given us is a couple of things. One is the large firms have given us something that we have needed to become a profession, and that is career paths. When Vanguard started hiring thousands of CFPs and putting them in these actual career paths with set training programs, like that is one of the value adds that large firms give you. In public accounting, everyone goes and works for one of the big four out of college, and after a few years, they decide, am I going to go corporate? Am I going to go independent? And so I think that is a huge win. But I never talk to advisors who are like, you know what I want? I really want to be owned by private equity. Like, I really want that pressure. No, they just want to work with their clients. They want to carve out their little corner of the market. And last thing I'll say to this is just it also just depends on what kind of business you want to build. If you want to build $1 trillion RIA, which I can't even believe I'm saying that word, but like we're starting to talk about the first $1 trillion RIA. Like if that's what you want to build, yeah, that's a tough road. And the private equity backed players are going to be very stiff competition for you. You're going to have to figure out how to carve that market out. But small firms, man, there's so much opportunity for them to run at this stage.
So, when I talk to advisors, when they ask me this question, how can I compete? I have a couple of questions I ask them. The first one is, why aren't these highly scaled firms offering lower pricing if they're that much more efficient? In fact, they offer higher pricing and they tend to specialize in wealthier clients because they can't seem to work with people who are less wealthy under their pricing model. And the other is, I wrote a fairly influential article a while ago asking advisors who'd sold to these larger firms. They said, what was it like? They all wanted to go off the record. None of them wanted to talk. But they said that the level of client service diminished. It didn't go up, it went down. And the reason was because immediately the owners were saying, let's look for more efficiency. And the first place they'd look is you're over servicing your clients. And I think over servicing your clients might be a competitive advantage. So that might be an
Yeah.
argument in your favor.
Yeah, I mean, look, the consolidation across the industry has actually been a big boom for our business. So, as the platform that's helping RIAs get started, when a PE firm comes in and starts consolidating and sort of mashing together firms, the culture changes. And I'm not here to tell you private equity is bad. Many of you on the call may build your firm to a point to where you sell to private equity one day. So I'm not going to say it's bad. I will say, to Bob's point, like I don't hear a lot of like positive experiences with private equity, but they have to be out there. Private equity is doing quite well. But people are built to work at private equity backed firms, or they are built to work at bootstrapped, founder led, owned companies. And I think the issue is when you go get a job in one of these RIAs, and you're part of this culture and you're in it together and all of these things, and then you get bought out by private equity and suddenly you're not the right person for the firm anymore. And what we're seeing is folks who have been with their firm for 10 years, they get bought by private equity. After about a year, they're like, you know what, this is not worth it. I can't do the work that I want to do in the way that I want to do it. So therefore, I'm going to go start my own RIA, and take a few clients with me if contracts allow that and such. So for us, it's actually been a big boom in terms of the independent RIAs that are getting launched because of the consolidation.
So the other question I ask sometimes is there any evidence that the larger firms are better coordinated or more efficient with their human capital? Because, the management and coordination challenge both grow almost exponentially with size. And so the average person becomes less efficient and effective because they have to pay attention to both the levels up and the levels down. And I have a feeling that negates any of the size advantages, the scale advantages that advisory firms are looking at with some dread. But what about the fact that these larger firms can create their own in-house software, customize exactly?
Oh, you're
Does
gonna
it
push
involve you
me.
an
You're gonna
advantage?
push my buttons, Bob.
Oh,
So we run our company on the EOS, the Entrepreneurial Operating System, and several years ago, EOS announced they got bought by private equity. They got a new ownership group, and they announced that they were going to be building EOS software. There were already a couple of tools out there to run your firms on EOS. They were going to pull the licenses from them, and they were going to build their own tech. And I remember telling our implementer at the time, our EOS business coach, I said, EOS is built to be a business coaching organization. They are not built to be a technology organization, and they will fail at whatever they try to build in tech. And so far, I have been proven to be right, because their technology is still not released like 5 years later, and what has been released is not very good. Building technology is a culture. And I get to live this where we have XYPN, where we do some in-house development, but we're a service business. And then on the other side, I have AdvicePay, where we're very much a tech company. And technology is a culture. Building technology, iterating, and sort of changing the color of a button and where it's located. All of those things happen incredibly rapidly in a technology organization. They don't necessarily happen the same way. Change doesn't happen the same way in service organizations. And so, what I can tell you from living this out on the AdvicePay side is in the early days of AdvicePay, we had several large firms that went out and tried to build their own product, and it just didn't work. They put resources to it, and then they got an initial version built, and then they moved on. They moved on to other projects, and we kept iterating and kept improving. And pretty much all of those firms that built their own in-house solution are now using AdvicePay instead of that in-house solution that costs them millions of dollars. So I would say, to anyone who is selling you on, we're going to, give you the all-in-one platform, the best tech, I don't buy it. The one exception, the one caveat I will say, are those that are building technology specifically for their niche market. So if you are working with Brooklyn FI, I think they're still building their tech. They've got a wallet for basically managing all of your stock options. So Brooklyn FI specifically works with clients with stock options and pre-IPO tech companies, and they have a wallet to sort of to consolidate the information from all the different places you may have worked into one place. That is good tech because it's proprietary to the firm. It is really niche. It's really narrow focused. It's not trying to replace a CRM or a planning software or anything else. So that's the one caveat I will give is that I have seen even small firms. Brooklyn FI is large for our community, but would be considered small in the grand scheme of RIA world. Even small companies have been successful building really niche software, but the platforms that are trying to build all-in-ones, we see them fail time and time again.
So I look at examples where people build software in-house, and it inevitably turns into legacy software. And legacy software, everybody laughs at how clunky it becomes. It might be really spiffy when it's first developed, but at some point it doesn't become. So somebody asked a question here. We're still on the same topic, to talk more about how over-serving clients is a differentiator. And I'll start by saying, the people I talked to, they said that the firm that they joined wanted them to stop meeting as often, wanted them to stop spending as much time with clients as they were before, wanting to cut back on services because that made them more efficient. And that tended to make clients less loyal, particularly when you're trying to transfer client loyalty, that you've built up for 40 years or 20 years or whatever in 6 months. And at the same time, they're cutting back on service. The clients are saying, wait, you're transferring us over there and you're cutting back on service and we're supposed to be loyal. The smaller firms, I think there's an opportunity, particularly if somebody leaves that firm and is still in contact with those clients, to say, I'm happy to give you the service you had before. I would love for you to come over here and get the service you had before. And by the way, we might not have to charge quite as much because we're kind of a startup and we're. So how do you see that?
Yeah, I think I agree with you that you can differentiate in a few different ways. I'm trying to remember the three. You can be the fastest, you can be the best, or you can be the cheapest. And I've never met it. Well, this is not true. There are some firms in our space that are all about being the cheapest. I don't do that. Like I don't need advisors who really want to compete on price. So then we have to compete on value. So either I have to provide better, like literally just be more available, better service. I would say the large firms probably do the be fastest better. I would think in a large scale environment, you should have the resources to response times back and bigger teams and that sort of thing. So the third one that you have to compete on is you can be the best and you can provide the best service, the best value to your clients. And I think that's where advisors, particularly in a small firm environment, can differentiate to be able to say, like, look, we're going to get to really know you and your family and your kids and your charitable interests. And I'm going to know your favorite wine, like all of these things that you can only do when you're an advisor working with 75 clients, not somebody who's trying to work with 300 clients at scale with sort of a standard service model. And so I think I wouldn't call it over servicing. I would just say like you're providing a higher level of service, hopefully for more money. But even if not, to Bob's point, like you do have some efficiencies when you're smaller. You don't quite have the overhead that larger firms have.
Okay. I'm going to move on to a second debate topic. I think I lost the first debate. I think you scored ahead of me in that one. The fact that I proposed a straw man might have given you some advantage there. All right, the second topic, in the fintech world's history, and I actually go back. I actually did the first software survey back in the 1980s, if you can imagine back that far, and I've been following it ever since. And I would say that most of the effort and the conveniences that were created by software, by the fintech world, were focused on back office efficiency, convenience, making it easier to perform operations tasks like filling out paperwork and going online to handle check requests. We didn't have online back then. Workflow engines, managing tasks that are performed on behalf of clients. But now we have AI. And with the AI, my proposal, my debate topic is the fintech world is going to take the next step and leverage the front office. And that means making client-facing advisors more efficient so they'll be able to handle more client relationships. The new revolution will be in the front office. What do you think about that?
I think it's interesting that when you look at the data over the decades in terms of number of relationships that advisors have with their clients, it really hasn't budged much, really not at all. And I think it comes back to, and I'm trying to remember, is it Pareto's principle of you can only have a certain number of relationships total? You can only know so many people super well, and you can only know so many people to a level that is required to do comprehensive financial planning. And but on the other hand, what we have seen is in the back office that the it used to be like for every one advisor, there were like five staff members, and then it went to one, and now it's even less. I believe it was on Kitsis's podcast. He was interviewing the founder of Timothy Financial, which is a massive hourly firm. They only do hourly work, and I may get these numbers slightly wrong, so I apologize. To the firm if I misquote these, but I believe they said they had 17 advisors and two members of the back office. That
Timothy,
is
Timothy Financial is the name of the firm.
Timothy Financial, yes. That is incredible. 17 to 2. I mean, that's like 8.5 to 1, like advisors to back office. And so what I see, I do not see advisors suddenly using it. And we have the advisors who are heavy into AI and all the workflows and automation, all of that. I don't
Mhm.
see them saying like, and now I'm serving 300 clients. What they say is I'm serving the same 75 clients, but I'm serving them with either higher levels of service and I'm hopefully charging more for that service, or I'm just taking more time off. And so what doesn't show up in the studies, we see fee compression or the theory of it, like we're going to see the fees come down, but we really don't. What doesn't show up, it's harder to parse out, is higher levels of service. I mean, Bob, you have some of this data that advisors are doing more for their clients. And I think they're working fewer hours than they used to, and especially for the small firms. And so to me, I don't see AI as a way to make an advisor more efficient in order to take on more clients. I think it is more of, I think that AI and all of this technology is just going to give advisors the ability to better serve their existing clients.
Okay, so
Dunbar. Thank you to David Lee. Dunbar, not Pareto. I'm awful my psychology.
when I went on a call with I forgot who, some big service provider, and I got on their phone tree, and I couldn't get off their phone tree. The AI system simply could not understand what I was asking for and would not give me to a person. Now that it may improve, but don't you think it's possible that AI will make, your frequently asked questions, it will automate the frequently asked questions, or it'll make it easier for advisors to get the answers to simple questions that maybe you've provided, but you provided in a group setting? Or is that
I
not?
just I don't think that's where advisors' bottleneck is. I think the bottleneck for advisors is simply getting to know someone to such a level that they can actually do real financial planning. If all you're doing is spitting out retirement analysis and it's like, okay, like 78% chance of success at 65 and you'll die at 90, like, okay, you can churn and burn those and have your 300 clients. But if you want to really, like, I have a financial advisor. So Jake Keebler is mine and my wife's advisor. And when I think about how he has spent, I think we've been working with him for about 5 years now, the amount of time and energy he has spent with us so that now I can call him and say, hey, Jake, I've got this opportunity. I can make this investment or buy this real estate or whatever the thing is. And he's able to say, tell me how this opportunity connects back to your core value of time autonomy. It takes time and energy to get to know someone to the point that he can just spout off my core values or our family's core values that we've come up with. And that is the bottleneck. Now, all these other things, these tasks, how fast can you open a Roth IRA and how fast can you get back to your client? All those things are important because it does take time from the advisor. But I don't think the bottleneck to growth is all the back office stuff. You can hire that out. If you don't use tech, you can use people. I think the bottleneck is there's just only so many people and families you can deeply know. And because of that, there's just always going to be a limit on the number of clients that an advisor can serve.
One of the arguments in your favor is the fact that financial planning services are evolving through life planning to coaching, that there's more intimate relationship advice being provided now than there ever was. I remember, you were talking about earlier the guy sitting in the middle of a presentation with his arms folded. I remember talking about life planning and coaching and how those were going to be important skills, and half the audience, which was basically all the former salespeople, would fold their arms and sit back and then poke their fingers in my shoulder and say, "We're not psychologists," or whatever they were saying. So if that is the trend of the profession, that's moving faster perhaps than AI capabilities are moving. That AI won't be able to catch up to that.
Yeah, I mean, and we'll see where the technology goes. I mean, folks have probably heard me say before, like, I hate the term AI. Like, what we have today is not artificial intelligence. There is nothing intelligent about it. It's just a really amazing predictor of the next letter, the next word, the next pixel, based on all the information that it's been fed. But that's a rant for another day. But I would say that, look, the technology is here. It's going to continue to evolve. But I also have read, I don't even think I was born yet when Schwab came out with their low cost trading platform. Like, we thought that was going to put all the stockbrokers out of business. And here we are. And then we had the advent of the internet. And then we had the advent of the robo advisor. And like all of these, like, global industry changing technologies got introduced, and we just adapted and evolved. And I think what we're doing is moving up the value chain. I think our value used to be, you call me, I pick up the phone, you tell me what you want to buy, I submit the order, I hang up the phone. Like, that used to be our value, was we were the only way to trade stocks. You had to call us. We've moved into then investment management, portfolio management, and then managing investment managers, and then financial planning. And now we're at this higher level. I don't know if it's the peak, but I like to call it real financial planning, life planning, financial therapy. There's different forms of it, but it's getting to really intimately know your client and then being able to connect their goals, their values with their money decisions. And I think that's where we're headed.
I read in Science News, there was a cognitive scientist who was asked about different information processing systems. And he said, anytime information is processed, there's awareness, there is intelligence. And they said, well, what about the AI platform, the Chat GPT-4? And he said, well, based on my research, I would say that it has roughly the awareness and intelligence of a roundworm. And so, I think you should turn your clients over to roundworms. I think that's the future of the profession.
Yeah, I mean, I was reading a really fascinating book. If anyone's interested in AI and just sort of getting up to speed, the founder of Khan Academy, the educational platform, he just wrote a book about AI, and education was the focus, but it's easy to make it applicable to financial planning. And it was really fascinating because he was actually looking back even 50, 60 years ago. They were designing computer programs that could provide therapy to patients. And it was basically, I can't remember the type of therapy, but when you say something, that the therapist repeats back what you said, but using different words and saying it differently. And then it sort of forces you to reinforce and to sort of work through that.
Yeah, it's
So
called
even 50,
transactional analysis,
thank you.
is the technical term for it.
So, like 50 years ago, computers were able to do that. And actually, what they saw were outcomes were fantastic for the patients who were using this system. So, what does that mean? I think that everyone is going to have access to an AI-based therapist one day. Now, I don't believe that it eliminates therapists. I think the humans are absolutely still going to be there. But what I do think is that it is raising the floor. There is a huge swath of Americans who cannot get access to mental health services because they're in a rural area that they don't have resources, they don't have the financial resources, they don't have the time. And so what it does is it raises the floor so that everyone gets access to at least some level of care, but that higher level of human interaction is still going to be there for those who can afford it. And I think the same thing in financial planning. I think we're already seeing that, where if you need a retirement plan or a great investment analysis, or you need your estate planning docs, like, you can do all that online, and yet they still hire us for a reason. The people who can afford it want that relationship.
A checklist is not intelligent, but it's certainly helpful.
It is. I mean, it's I think ChatGPT is an amazing thought partner. Like, I mean, I mean, there's a few different use cases that I think it's amazing for, but that sort of bouncing ideas back and forth, it actually is really helpful, but it requires you to start that conversation. It requires you to sort of tell it what direction you're trying to go in order to get value out of it.
All right, so third debate topic. I think I totally won that one. So I'm gonna chalk that one up to me. So there, yeah, you might have noticed there's a lot of debate around revenue models these days, and particularly whether assets under management, that model is appropriate for the advice profession going forward. And Michael Kitces, who you might have met at one point or another, he's objected to all the alternatives to AUM because of what he calls saliency, which means the other models make fees more visible to clients. So here's the debate. The underlying assumption of this saliency objection is that if the fees that advisors are charging are more visible, clients are going to push back on paying them. And that suggests that if the profession moves away from AUM, their fees will decline by some amount as they face that pushback across the profession, across the future. And maybe there's another way to look at that also to frame the debate. Sometimes you see anomalies in the marketplace that are eventually corrected. Um, some years ago, in an article I wrote, I calculated that investment bankers on Wall Street, on average, earn 300 times more than the average school teacher. And I don't think most people in the audience think that investment bankers are 300 times more important to our society than school teachers. So and maybe more evidence of this. The average advisor coming out of college earns more initially than the average newly minted doctor or lawyer. And the doctor and lawyer have to pass fairly rigorous educational and exams in order to get where they are. The advisor has to pass the CFP. So the debate topic really is, are advisors overpaid right now in their professional activities? And is that going to correct itself as we shift revenue models if we do?
Well, I'd be curious, have you ever looked to see if investment bankers are making less than 300 times the average school teacher now?
I haven't revisited that, but I think they're probably making more, not less.
I would assume so as well. And again, for the service that they provide, there is a dollar value. Now, value to society is different than the economic value that's being generated from their work. And so, I mean, I look at that and I see like, all right, well, yes, does technology eliminate certain jobs and bring costs down? Sure. But I don't see advisors making less money over time. I do think there's like a couple of tranches of this. So for the old school alpha, salespeople out there selling like crazy, making millions of dollars selling products, like I don't know that we're going to replicate that because we have entered into this new phase of business where we're not selling products and it's not about like selling one big product and you make a ton of money. When you're providing ongoing planning, it's a little bit more stable of a revenue. Um, but I don't see advisors over time making less money. I mean, I do agree with Michael that, and we've seen this, that look, AUM fees are wonderfully obfuscated. Like you can't see what you're paying. There's the Tiburon conference every year brings out 3 to 4 consumers. And one of the questions everyone gets asked, and these are consumers of they are clients of financial planners, they say, well, how much are you paying in fees? And like, I don't know. And like, do you care? And so like, no, I don't care. Like, I don't know what I'm paying and I don't care. And so for me, I'm like, I want to know exactly how much I'm paying. But for many, of the delegator wired folks out there, like they don't necessarily care. They just want to know, hey, I've got this peace of mind, I have this value, and I'm willing to pay for it. So again, I don't see people who are I mean, look, let's be honest. Financial planners, CFPs are working with the top income earners or net worth, in America. Like we are not working with all Americans. So for the higher income, higher net worth folks who have the ability and willingness to pay, I think they will continue to pay, and over time they'll pay more for more services. I think what the technology is going to give us is the ability to bring the floor up so that everyone's getting some sort of baseline level of service, but not necessarily through the traditional RIA model.
So if you bring in a different cohort of clients, theoretically, they're able to afford less, to pay less for the same service. So, right now, the focus really is on people who pass a threshold. They're above, a million, 2 million, whatever the floor is. And suddenly you bring in people who are still accumulators, who haven't acquired as much. And a lot of those people may not have as much income as some of those people too. So if you blend that in, is it possible that the advisory firm with a broader mix of clients in the blue ocean is going to be having to live on less revenues?
I would say that, and I don't have any data to back this up, but I just see this with our firms, is that when we talk about niche and like where are you going to focus, one of the things that we've seen is that advisors tend at scale, once they've sort of gotten their business up to a certain point, not day one, but at scale, the advisor tends to make about the same amount of money as their clients make. So if you're working with clients who make $1 million or more, you tend to make $1 million. If your clients make $50,000 a year, you tend to make 50,000. And it just backs into what's 1% of AUM, or we see roughly about 2% of income. And so if your clients make 100 grand, you're charging 2%. You've got expenses. It works out to about 100 grand. And so I do think that if you take a firm who has only historically served high net worth clients and you start expanding the service model to working with clients that pay less, that the average of revenue per client will go down. I think that average compensation for advisors will go down. But your experienced advisors that have those large relationships are not the ones working with the kids of clients, or these new sort of up and comer clients that can't yet afford your historic minimums. And so what I think you'll see is that you're starting to build in these career paths where these younger advisors can come in, they can get reps from day one, actually talking to clients and start to work their way up the income ladder. So that's at least what I've seen.
Okay, and I guess the underlying question is, do you think that assets under management, I have sounded this alarm for years. I've said that I don't think assets under management is an appropriate way for professionals to charge for their services. I don't think any other profession would even think of saying, when someone asks you how much am I going to pay for your services, they say, I'm not sure. How much have you got? I don't think, that. So are we going to, and all I'm doing is sounding an alarm. I'm not saying you should charge this other
Yeah.
way. I'm saying, I think there's going to be an evolution in it. I don't want it to catch my readers by surprise.
Yeah, I do not. In the early days of XYPN, folks thought we were saying like monthly, everyone's going to be doing monthly subscriptions. AUM's going away. It's going to get replaced with monthly subscriptions. And that is not the case. We have never seen fee for service, whether that be hourly project, retainer, subscription, as a replacement for AUM. We've seen it as a complement to AUM in the sense that it allows you to work with this massive swath of potential clients that you couldn't work with them under an AUM model. Um, I don't know. When I think from everyone's got a different opinion from an ethics standpoint. It kind of reminds me, I don't know if this is the best, metaphor line, but like in the early days of XY, we still are, we're entirely inbound. So our growth comes because people see our content, they hear us speak at conferences, they listen to the podcast, they meet other members, and they reach out. And I was talking to another CEO, and I said, and they had this like really awesome outbound sales strategy. And I was like, man, like you've got this cool strategy. Like, how are you doing that? We rely entirely on inbound. And he was like, I would kill to not have to do outbound. I would kill for your model. And the reason I tell that story is because I was looking around like, well, what's the better way to do this? And he's looking at our business thinking like, oh man, like he's jealous of the way we've built our sort of our content funnels. And I think the same could be said where are there other industries that are charging 1% of assets? No. Do I think there are multiple professions that would charge that if they could? Absolutely. And so I'm not sure that it goes away versus people sort of maybe even migrating towards these ideas of like usage-based pricing and that sort of thing, which is kind of what the AUM model is. So I'm not here to say AUM is perfect. it does have its drawbacks. Obviously, we've seen the rise of the advice-only advisors, and really hitting a market there that has not been served historically. So I think there's opportunity, but I don't think any of those fee models are going away, and I don't think any of them are going down in usage. I think you're just going to see more of a blend of fee structures out there versus just everyone being one or the other.
I guess I can leave it there and go to the next debate topic. Um, all right, so next debate topic. Over the last 40 years, as I've been watching the profession, I've seen it begin to normalize the way firms are run and how they offer service and how they charge for it. So, does an advisor entering a profession today have less room for creativity than advisors in the past when this profession was more of a Wild West? Are we constrained in how we do things now that we weren't before?
Hmm. It's a really interesting question. Do I think there is less variability between firms than there used to be? Um, I guess is one question. And I'm not sure that that's the case. I think the larger a firm gets, the more standardized their processes and systems become. But when I look at the way XYPN advisors are running their firms, they can be vastly different. They get a lot of creativity. So I think it just comes down to what type of firm environment you're in. Look, you go work for Vanguard's advisor services, you get no creativity. And I'm sorry, if anyone works at Vanguard wants to correct me, that's fine. But like, I don't think you're going to get any level of creativity at Vanguard or Schwab or Fidelity or any of these major firms because they can't oversee and monitor, that creativity. So if you want to flex those creative muscles, you're going to have to get into a small firm environment, whether that be a solo or just a small firm that's focused on your niche. So I do think there's lots of opportunity. I mean, I was talking to an advisor recently that, they work with traveling families with young kids. And so he bundles in like a travel concierge in his planning fee. And so if you hire him to be your financial planner, you get access to this third party planning coordinator. And I'm like, that's amazing for his niche. If I had done that in my firm back in the day, that would have been a really silly use of money. And my clients would have been like, what are you doing? Like, that's not what we needed. And so I think he is very creative. And I think he's got the room to flex there. So yeah, I would say that I think it's probably the answer is probably both. Yes, there's opportunity for creativity. Yes, there's areas where creativity is harder to come by, but I think that's all comes down to the type of firm you're in.
Does it make it harder for you to communicate what you do and what services you provide when when the models are all over the place and the services provided are all over the place? I mean, we've been
I
trying
mean,
to hone a message for decades now. Is that muddling the message?
yeah, I would say that, look, I've never worked in a large firm, but like if I go to, like, I don't know how the big firms, Mariner, Edelman, Carson, like all of those folks, I'm not picking on any of them. They're just mega firms. Like, I don't know how those advisors are differentiating their services from advisors at the other firms. And I'm not sure if they are. And so I think you probably are seeing some standardization at that level. But I believe that there are some clients that are looking for that standard service model, and there's a reason those firms are growing. I also believe that there are clients who are looking for something that's more customized to their unique situation. And I can pull up dozens of examples of advisors that have when they focus on a niche. Now, this is all predicated on having a niche. For anyone who knows me, I can't get through a webinar without saying that word at least 10 times. Anyone who has a niche, then it makes it really easy to figure out the service model, which may be completely different than the service model for another advisor. The end result is still the same. We are helping our clients achieve their great life. That's my definition of financial planning, is helping our clients define and achieve their great life. We're helping them with their peace of mind. We're helping them align their values with their money decisions. All of those things are the same, but the way that that gets accomplished and the service in order to get there is very different depending on which niche market you're serving.
I guess my last comment on this particular debate topic is that the more creative you are, the more capable you are of competing with the large firms because the large firms are offering a standardized product. And there's
Yep.
some people want the standardized product because they know what they're getting. but I think there's a lot more excitement around something that's more customized. And we have an infinite opportunity to customize because there are an infinite number of individual people in this marketplace.
Yeah, and also I want to be sure for attendees, like I think you can absolutely be creative and build a really cool system and then operationalize it and scale it. And so I don't want you to take this as we're not talking, or at least I'm not talking about like you have 100 clients with, and everyone is getting financial planning 100 different ways, and you can't scale that. You can't hire, you can't hand off that institutional knowledge. There has to be some level of standardization. And so you can still be super creative when you're building product market fit, when you're getting the initial sort of service model and value proposition for the right client and the right pricing sort of all figured out. From there, once that's done, then you can scale and scale that creativity.
All right, we've got 15 minutes for a last debate topic. Are you ready for this
Let's
last
do
one?
it.
All right. Um, Financial planning, as I think we can agree, is fundamentally an advice profession. And increasingly, the asset management side of the service is being commoditized. I think almost everybody agrees with that. It's not really that difficult now to go online and find reasonable portfolio models. Yet the portfolio management reporting software tools cost 10 or 20 times as much as the financial planning, tax planning, social security planning programs in the fintech marketplace. 80% or more of an advisory firm's fintech budget is being spent on the software that addresses the services that are being commoditized. And advisors have said to me, it's less important for my clients, less important for my value proposition, and costs more every year. Should the planning profession demand that the portfolio management software programs cut their fees, or should the planning programs demand a higher share of the fintech budget?
I would say no. And I've never run a portfolio management company or I don't have any insights into their business. But I would say there's probably two sides to this. One is the underlying expense side. And that is anytime you are dealing with portfolio data, at least today, and maybe AI helps to standardize this, it is incredibly expensive to pull that data in, normalize it, fix the errors, because you can't run a performance calculation or a fee calculation or anything else if you don't have every single data point in a line. You have one gap and it throws everything off. And so it is really expensive to pull that data in and make it something that the advisor can use. And so, I'm a believer in free markets. I think that the what it costs, there's a reason all of the portfolio management softwares out there are pretty expensive relative to planning software. And I think it's just because it's harder to build and maintain. So that's one side is I just think there's an underlying cost structure, expense structure for the technology providers that they have to deal with. The other side is that, and we deal with this at AdvicePay, where sure, I would love it if a firm would spend $1 million a year on our payment software, but they don't even make $1 million a year on planning fees. And so I think what you'll also see is that the relative portion of how much we're spending on planning software versus investment management software is probably in line with industry trends in terms of what percentage of our revenue is generated on financial planning and what percentage is generated on investment management. If you're a firm that makes $300,000, 250,000 comes from investment management, 50,000 comes from financial planning, you're going to be willing to spend more on tools that support that 250,000 of revenue. And so I don't think advisors can force this, but I do think that as advisors, as we continue to see the march from investment management to financial planning, a realignment of fees around the value that we're providing, then advisors will have more planning revenue to then spend more on the value adds and services.
What I'm hearing from people in the marketplace is that the portfolio management programs are increasingly adding complicated, sophisticated services that are features that they don't use.
Yeah.
And so that adds to the price. What I think they're asking for, what they're asking me for, which is kind of the wrong tree to bark up, is the something that's a stripped down version of simply showing clients what a trading platform, a rebalancing platform, and showing clients what they have and what their performance is. And for some reason, those programs have never, there are some, but those programs have never gotten traction.
Yeah, fintech in financial planning is a tough space because such a large percentage of the firms that are out there have hit sort of success. They've hit sustainable. They're making as much money as they want to make. They're a little later on in their career. I mean, the average age of financial advisor is still 56, 57. And they don't have any incentive to adopt new tech. They don't care. They don't need, like, it's not worth the hassle of moving from a big player to a small player and taking the risk. You can just sort of coast. And I think that, at least that's been my experience selling software in this space, is that you don't have to be 10% better than your competition. You have to be like 5 times better, or a 5 times better fit for your than the competition in advisor world, in order to get them to move. And so to move softwares. And so there are some exceptions. I do think certain softwares, like some of these AI meeting note tools, like I think those have a very low cost switching cost. You just turn one off and you turn a new one on, you're good to go. Portfolio management, when they hold your data, that's a much bigger conversion. And advisors, in the end, the fintech companies need to make a certain amount of money to survive. And if they can't get advisors to switch softwares, it's hard to keep reinvesting into that feature set.
We've got 9 minutes left. Should we take questions?
Let's do it.
Okay, let me see here. I've been looking at the questions that have been going on. Most of them have been comments. Alan is an idiot. Alan is really stupid. Bob, you're totally winning. These are great comments. Keep
Yeah,
them.
these are great.
You know, so one of the questions was, though, is how do you differentiate your value or communicate your value and charge appropriately if you're not charging AUM? I guess that's the gist of
Mm.
three questions that I'm seeing here.
Yeah, I mean, I always look at, who is your target market? And so advisors will ask me, well, what tech should I use? Or what's the best marketing strategy? Or how do I manage compliance on this thing? Or whatever. And it all comes back to, well, tell me who your ideal client is. Because if you tell me you work with new parents who just had their first kid versus optometrists that are going to be selling their practice in 5 years versus women at pre-IPO tech companies with stock options, like, your marketing strategy, your fee structure, your technology, your service model is completely different between those firms, because the needs of those clients are so different. And so generally when I see advisors get hung up on what's the right fee model, they're asking the wrong question. There is no right fee model generically. There's lots of fee models for lots of different kinds of clients. Once you get really clear on who your target market is, the ideal fee structure for them becomes really clear. You cannot charge AUM to clients who have all their net worth in a business or all their net worth in stock options. There's no money. There's 1% of nothing is nothing. That's not a business. Like, you have to charge a different way. And so there's plenty of opportunity for that, but you got to get really clear on who you're serving.
The issue to me is messaging. We're finally at a point, I think, in the profession's evolution where most people now kind of know what financial planners do. They don't walk in and say, I want you to beat the market by 10% a year or something. You don't hear that anymore. But I think the next phase of messaging, so now people see that there's value in financial planning. The next phase of messaging, I think, is what you're talking about. It's that personal connection. It is, I know your idioms, I know your challenges, I know the kinds of things you're gonna run into. I have deep expertise in how to set up that optometry office, or how to sell it, or who the buyer might be. And that's a different communication issue. That's a communication issue. I'm a financial planner, but I do specifically what you need me to do. And I think you can charge almost anything for that.
Yeah, totally agree.
Okay.
So, Bob, I want to answer this question about corporate RAAs, since this is something that we've been working on here with our new corporate RAA, XYPN Sapphire. So the question is basically, how will the new crop of these corporate RAA affiliation platforms, such as Sapphire, be able to attract experienced advisors when they can't offer six-figure sign-up bonuses like the wirehouses, or offer the ability to sell their firm at the end, like if they start an RAA? So I would say on the front end of this is, look, if you want a six-figure retention bonus to move from one wirehouse to another or one broker dealer to another and lock yourself in for 7 years, and you're not thinking about what's best for your client, you're just thinking about how much money you're going to make, go for it. Like, there's plenty of opportunities. Plenty of people will write you a check. We have grown XYPN to over 2,000 advisors without ever paying a single referral fee or recruitment bonus or anything like that. And I think because we were just an option for advisors who said, I want to do right by my clients, I want to do the best thing for them, be able to provide the best service, live my great life, that sort of thing. And therefore, I'm going to go with a platform. So I'm going to go start my own firm. And so for us, we have seen I mean, I don't know, maybe if we were paying recruitment bonuses, we'd see more growth, but I don't think so. I think that's part of what makes us stand apart. And the other thing I want to address is the second question of, not being able to sell your firm. That is false. And so now every corporate RIA is different the way that they set up. But the way we established our corporate RIA is that you maintain an entity. You maintain your LLC, and we pay that LLC your fees. And so you can sell that entity. We're not in the buying market, but maybe one day you could sell it to us. You could sell it to another one of our advisors. You can sell it to somebody that you meet at a conference. And so the affiliation model does not necessarily strip you of your independence. That is something that we've been able to really focus on keeping, but just know that there are options out there. Bob, are you seeing anything with these corporate RAs? Because it does seem like there's more sort of independent corporate RAs popping up.
Yeah, I wrote an article about Forum Financial, which is basically a partnership. You become a partner of Forum Financial, but you maintain your own P&L in your office. You can choose your own successor, and you can sell basically your office as if it was an independent office.
Yep.
Basically, they're all opportunities to gain scale without giving up your own independence, without giving up your own flexibility. And I think that's probably where it's going. That if you want scale, and I think most people, when they look at compliance, especially, they're saying, maybe somebody else could do this. Then you can get that without having to give up equity, without having to give up your independence. If you're wanting to give up independence, you sell and you can give that up that way, and you can put some money in your pocket.
I mean, the one word of caution I will give advisors, just because I've seen the dark side of this industry, is we've had advisors move over to Sapphire, and their agreements are exactly, now I'm not picking on Forum, I don't know their business model, but just generically speaking, these advisors have agreements that say these are your clients, you can leave at any time, take your clients with you, all the things. And then when they go to leave, the firm turns off their access and they call all of your clients and they say, well, I can't tell you why Bob's leaving, but it's not good. It's a gray area. Like, I think it's across the line, but it's legal. And so I would also caution, like, be thinking about it from an independence platform. It's like, are you joining a platform like XY where if you don't like Sapphire, you just let us know and we'll register you a firm and move you to what we now call XYPN Emerald. We'll just help you launch your own firm. That's what we've done for a decade. We'll continue to do it for the next decade. Is having that sort of escape valve. You need to know how to leave and if it's going to go well. And I will say that even the best written contracts, if they have a culture of not being on the most up and up, then you can still struggle. So something to think about as you're for anyone who's evaluating these platforms is sort of what's the exit path and do you trust it?
I think you need a Ruby platform and an Opal platform, and maybe
That is why we named it Gemstones, was it gave us some flexibility. You can thank the marketing team for that.
fair enough. I I have run out of debate topics. I think I pretty
Yeah,
much,
and we have run out of time, so it works perfect.
yeah. So
Well, thank you everyone for joining for this part two with myself and with Bob. This was a lot of fun. Always fun to talk industry with an expert and somebody who has sort of seen a lot of the transitions that we've been through and can accurately predict where we're headed. So thank you, Bob, for joining. Thanks everyone for tuning in, and we'll see you next time.
all right, thanks, Alan.